And our job as advisors is to navigate the landscape as it is to try and get the best result for people.
Yeah.
It becomes extremely difficult if the goalposts keep changing. Now, if you've got a system that is controlled by a government that continues to change the goalposts and break their promises, then how do you plan for anything? Because it could change tomorrow.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again on a Friday and back again with another podcast. Although it's a Friday for us, not for our listeners when this has been published.
It'll be a Wednesday for our listeners, but we are recording it on a Friday before the Wednesday. So just to time stamp it, we are recording this at the start of February. However, the data that we're relating to, because it is a market wrap, is for January. But yes, it is a Friday and we're very excited because we love Fridays.
Exactly right. Exactly right.
Andrew, lead us off. What are we talking about, or where are we starting more importantly?
Yeah, well, you've already covered that one, that we're doing a bit of a market wrap again today, and we are talking about what's been happening around the world or in the world of finance over the month of January. And we're starting over in the States. That's usually where we start. And the US market is hitting all-time highs. So S&P 500 is up 2.17% for the month. And that is starting to hit the all-time highs of the US market, which is very interesting in the context of what's transpired over the last 12 months.
Yeah, well, that's actually a good lead into talking about GDP growth as well too. So we're looking at the Q4 data. GDP growth was 3.3. And when you're looking at GDP growth, the growth of the economy, and then how that reflects onto the share market, we're still seeing decent amounts of growth, which would translate to that the businesses that are represented on the stock market are having a positive return because they're obviously doing a lot of business and a lot of commerce. So those two things tend to line up. But yeah, it's really positive to see S&P up 2.7% for the month of Jan, which a move like that, if it was extrapolated out, you're talking a fairly healthy return for the composite. Whether or not that continues, we'll wait and see. But yeah, so far so good.
Yeah. So Qantas, soft landing. Is that
we haven't gotten to that yet, but I'm sure we will when we talk about the domestic stuff in Australia.
Yeah, exactly right. And look, there's some talk, and one of the things that has been on the cards for a little while yet, but is often talked about, is what's happening with interest rates. Mm-hmm. And based off some of the commentary coming out of the Fed, there's some implications that there'll be a 75 basis point cut over the course of 2024. Now, that's probably a little bit less than what's the market expectation. I mean, market expectations are probably expecting 4 rate cuts rather than 3, but nonetheless, the expectation around the grounds from an economist point of view is that rates are going to be coming down, and they're going to be coming down over the course of 2024.
Yeah, and look, we're seeing similar commentary in Australia as well too, and that is what it is. It's fine. I mean, trying to predict this stuff so far out is another thing. But I think what's really positive with all of this stuff is that there's consensus right across the board that where rates are at the moment are set. So we're not, we've got a better landscape in terms of what interest rates are doing in terms of have they stabilised at this level. I mean, if they go down, everybody's going to be happy about that anyway. But yeah, you're right. Absolutely. Good indication moving or looking forward in terms of what that looks like. And we'll mention a little bit about, I guess, the Australian outlook too, because that's probably where most of our viewers and our listeners are interested in terms of what's going to happen with interest rates in particular for the impact that it has on mortgage repayment. So
yeah, exactly.
And then that's a really good segue into core inflation as well too for the US. So we're looking that core inflation has fallen to below 3% for the first time since March 2021. So, Andrew, are we talking an annualized figure for that 3%?
Yeah. So that's an annualized figure over that 3%. So we're really starting to see inflation come under control, which is why you're now starting to hear some chatter around rate cuts. Now that we're at a point where really there's inflation is more or less, I mean, you don't want to say under control because it's still relatively high or higher than what you'd normally expect inflation to be at. But all of this data and all of this is all interlinked together. I mean, the biggest concern for markets was inflation. Inflation is now under control. And so as a result, you're starting to see the share market respond very positively to that fact. Then in addition to that, you're now talking about the rate cuts in order to be able to spur on further growth as an economy progresses through that cycle. So it's painting a far rosier picture, and that doesn't mean that it's guaranteed and things can't turn very quickly, but it is painting a far rosier picture for investment markets, particularly in the US as well.
Yeah, and we take the lead from America. I mean, they're the leading economy in the world, so we take our lead from them. If what they're experiencing is an indication of what we're going to experience, albeit they move earlier, it's a really positive sign for the Australian inflation outlook. And we'll talk about a little bit about our inflation data later on, because that came out and that was heading in the right direction. But assuming that we follow America's lead and our economy responds the same way, and Andrew, get ready to interject with Qantas here, but I think that soft landing that we've been talking about for a while is more and more likely to happen.
Yeah.
It's going to be interesting to see how it impacts and plays out on unemployment, but we'll wait and see what that looks like as well too, because there's a little bit in that we'll unpack a little bit later on. But Andrew, I guess changing continents, let's talk about China in particular. What's going on with them, second biggest economy in the world? A little bit of a different story over in China.
Yeah. I mean, you compare and contrast China to the rest of the world, and they've always been sort of acting as a bit of a silo and have been acting outside of what the remainder of the economy has been, or the direction that the remainder of the economy has been moving in. But Beijing has announced a US $278 billion support package to their stock market. Mm-hmm. So they're really starting to need to make need to put in some additional stimulus into their economy in order to be able to keep things moving. And really the market they're looking for additional stimulus. There's some concerns around housing, there's some concerns around the economy, and we're starting to see some cracks in the Chinese economy, and it really just depends on how much support and how much money they're willing to pump into that system.
Yeah, and that's a really good segue into, I guess, the backbone of the Chinese economy has been property for such a long period of time. China's biggest developer, it's been in the media a little while ago, but it's finally at breaking point now. But the Chinese Evergrande Building Company has gotten to the stage where they can't continue to operate, so they've been ordered to liquidate. I think that's the biggest property development company in China, and I guess that's causing a lot of pain, because that would be the same as, say, the Australian economy, that if our building sector or our property sector was struggling, it starts to impact the rest of the economy. They tried to restructure this business multiple times without any luck, and it's causing significant issues for the Chinese government to try and figure out how to not necessarily revive this, but to try and prevent that collapse of that company then spreading to the broader economy, which is the reason why they're putting and pumping so much money into their share market to try and support it. But a little bit of a different story in China. It's a much different issue to contend with than what we're experiencing in the US and also in Australia as well too.
Yeah, which is interesting to Australia. I mean, the resources sector in Australia is very heavily dependent. Probably not as much as what it has been in the past, but it is still very dependent on what happens over in China. And so whether there's additional stimulus in order to be able to support growth, and that, bodes well for the resources sector, or whether there's not enough stimulus and things start to spiral out of control, then obviously not very good for the Australian resources sector. Yeah. But over in Australia, what's been what's been happening in the Australian market, Bills. That's what most people are waiting to hear about.
So, Andrew, let's talk about where the market ended up for the month of January. But then I really want to talk about the next thing on the list, which is the tax cuts, because this is a juicy one. So I'm going to do two in a row.
We
here.
probably could have done a podcast just talking about the stage 3 tax.
We actually might, we might do a little bit of a spin-off. But look, the ASX was down 0.54% for the month of Jan, so relatively flat. But in saying that, when you look at where we're at from a market perspective, we're approaching all-time highs. So I guess the stock market is healthy at the moment, which is great, and everything that we're seeing so far is supportive of a soft landing. The interest rate lever is set at the right stage. We're talking potentially down the track of interest rates reducing. So far, so good. How that plays out, like I said, with unemployment, we'll wait and see. Maybe we'll talk about that in a sec. But I really want to get onto the stage cuts. So
I'll let you have this one, Bills, because you're very excited about this one.
I'm very excited to stick the boots in, to be honest with you, because we are, as a country and as people, I think we're too laid back, right? This is something that has been legislated. The stage 3 tax cuts have been legislated and they're done, right? The ink is dry.
Yeah.
And then Anthony Albanese, for weeks leading up to his announcement, basically said black and white on TV. He said that they're not changing them, right? And then all of a sudden, bang, we're going to change them. Now,
After he's gotten elected, despite the fact that it was an election promise that he would maintain the tax cuts.
How this guy survives the next election, I've got no idea. Why the opposition government are not plastering this throughout every media outlet in the country that our Prime Minister is a liar. I'm going to say that again for dramatic effect. Our Prime Minister is a liar, and anybody that votes for a liar is un-Australian. Let me put that out there.
So you can see where Billy lies. He's not sitting on the fence here. He is swinging for the fences.
The reason why is because from our perspective as advisors, and we're kind of getting off the market wrap here, but our perspective and our job as advisors is to navigate the landscape as it is to try and get the best result for people.
Yeah.
It becomes extremely difficult if the goalposts keep changing. Now, if you've got a system that is controlled by a government that continues to change the goalposts and break their promises, then how do you plan for anything? Because it could change tomorrow.
Well, I've got almost it's not at all a different opinion, but maybe a different way to work around it, in that I feel that if you're making an election promise that's especially of such a large scale,
That's been legislated.
that's exactly, and that's also been legislated, and you break away from that promise, I think you need to call an early election, because it's like me running for the Prime Minister of Australia and saying that everyone is going to receive a $100,000 bonus the day that I get elected, and then I get elected and I say, don't worry about it, I'm going to break that promise. I mean, you can't run on a basis of this is what I'm going to do and then break that promise and then expect to still be in power for another 4 years. Surely it can't work like that.
Anthony Albanese, mate, your time is up. You just don't know it yet. There you go. Andrew, let's talk about CPI.
No. We need to talk about what the stage 3 tax cuts are. We haven't even talked about it. All we do is just give our opinions.
Just give a bit of flack to the to the Prime Minister. So the tax 3 legislated, the legislated tax 3 stage cuts. Whew, jeez, let's compose ourselves, right? The legislated tax 3 stage cuts were basically signed off by all levels of government. What it was is, depending on your tax rate and how much money you earn, you'd be entitled to certain tax relief. And now they're coupling that with cost of living relief as well too, even though when they were legislated, cost of living was not an issue, so that's interesting within itself. Just trying to put a bit of an extra spin on that, the political spin. But essentially, a lot of the support in terms of the stage 3 tax cuts were going to the higher income earners. And what the Labor government have done is broken their election promise, just in case you didn't hear that before. I want to emphasise that again. But what they're doing is they're rebalancing the stage cuts, and they're taking or giving less of a tax cut to the higher income earners and redistributing that to the lower and middle income earners.
Yeah.
Essentially, that's what they're doing.
Yeah, which from an investment market standpoint as well also causes potentially some issues from an inflationary perspective. Statistically speaking, when you're giving more money to lower and middle income earners, they're more likely to spend that disposable income. And so as a result, you're likely to also see that be inflationary in nature, which is also contrary to obviously what we're trying to do from an economic standpoint, in that we're really trying to curb inflation. And that's why we've seen interest rates rise to the rate that they have. So is another example of the left hand not talking to the right hand, in that on one hand, you're trying to reduce inflation. You're doing all of this work from an economic standpoint to bring inflation down. And then on the other hand, you're doing things that potentially might, if you're talking to Billy, lose you an election. But if you're talking to maybe lower and middle income earners, maybe it's a positive for them. But it's from an economic standpoint, it's two things that ultimately don't really add up.
Yeah, and just to clarify, because I think we should timestamp this, I'm saying that he's gone, right? And the reason why, it's not about the impact that it has to the individual.
Oh, of course.
Some people gain and some people.
Are you going to be a man of your word, or are you not?
It's the broken promise. And if we can get a broken promise from the leader of the country, while he denied that for weeks and weeks and weeks leading up to the announcement, I think the integrity of you as a politician, Anthony Albanese, needs to come into question, and you should be ashamed of yourself. And you know what? I'm calling for your resignation. How about that, Andrew? But no, on a serious note, I reckon that he's gone. What do you think?
Look, I think so too. No, I think so too. I don't think that you can break a promise that's as large of that nature. So yes, of course, politicians will break their promises over time, and they'll, deviate from one way to another. But this is something that was in legislation. This is something that was already signed off on, and has been for a number of years. And you've essentially been elected on the basis that you're going to maintain this promise, and then decided, 6 months before, not even 5 months before it was to come into effect, to break that promise.
Yeah. Yep. There we go. Andrew, inflation.
Yes, inflation. We had some inflation data coming out. What was it, about a week ago now, since we're recording it. So annual inflation was at 4.1% in December quarter of 2023. Now that was lower than the 5.4% rise in September. And is really, now we're looking at inflation that's at a 2-year low. I think market expectation was going to be at 4.3, and we ended up at 4.1%. So not only are we bringing down inflation, we're also bringing down inflation at a more rapid rate than what we ultimately expected it to.
Yeah, and this is great. And if you think about the change from the September quarter, moving from, and I don't want to get lost in the numbers here, but moving from 5.4 annualized to 4.1 annualized, we're talking about a difference quarter on quarter of 1.3%.
Yeah.
If we stick with the RBA's target inflation rate, we're talking between 2 and 3%. If we achieve in the March quarter the same type of result that we've experienced here, and we reduce by 1.3%, that puts us at an annualized inflation at the end of March at 2.8%, well within the band.
Doesn't work out as simple as that, but yeah.
It's not as simple as that.
But I exactly understand your sentiment.
Our approach towards the RBA's target cash inflation range is well and truly on track.
Yeah, exactly right. Which really brings us to, what's been happening with unemployment bills. Run us through it.
Yeah, so look, unemployment remains quite low, which is positive, because if you think about inflation and it moving down towards target, it's a positive thing. But if you think about the mechanics that happen behind that, and it's probably easier to think about it the other way, thinking about what causes inflation, where you can't, supply and demand is out of whack. You can't employ people. So what you do is you your coffee shop versus my coffee shop. I'm going to pay the barista $25 an hour, and you desperately need them. You're going to pay them 27, and I'm like, no, I can't afford it. So you pay them, but as a consequence, you put up the price of your coffee. The same happens in reverse as well too. So if we're seeing inflation come down, then it would start to have an impact on unemployment because people need to unwind that position. At the moment, we're seeing that unemployment remains relatively low, which is a really positive. And the increase in recent months is larger than at the start of most of the RBA's rate cutting cycles to unemployment.
Yep. So we've seen it start to take a little bit of an increase in unemployment, but by no means, I mean, we're still at a very, very, very low employment or very, very low unemployment rate.
At the moment, we are.
Yeah.
Where that goes, I'm not so sure. I think, look, if you think through it logically and inflation needs to come down, you'd expect unemployment to increase. That the two have to work hand in hand. But I guess this thing that we're talking about with this soft landing and the projection of future interest rate cuts is trying to get this balance right between driving CPI back down to normal levels, keeping unemployment at a healthy, and we've spoken about this on the podcast before about optimum rates of unemployment, but keeping unemployment at a healthy level and then using the interest rate lever to influence that is the challenge. And that's the soft landing about trying to, land the economy without causing too many issues and too much damage on the way.
Yeah, absolutely. And I mean, that ties into, what the RBA is likely to do with rate cuts. So there's been some revision around where the market is expecting rates to get to. So the market's really pricing in rates to sit at about 3.85% towards the end of this year. So that does imply that there's probably a couple of rate cuts that's likely to happen over the next 12 months. Mm-hmm. When that happens, that is what's kind of the course for debate at the moment. I mean, most economists and most people are talking about the fact that it's likely to happen probably closer towards the end of the year. I don't think that we're likely to see rates come down in the first or potentially even the second quarter of this year. Mm-hmm. They still may, but what the RBA is really trying to do is make sure that you're bringing down inflation. You're not then cutting rates and all of a sudden it's given everyone some newfound confidence to go out there, spend money, and all of a sudden you've got an inflation problem all over again. And you need to then start increasing rates at an even more rapid pace, and it causes a whole raft of other issues. So we are expecting some rate cuts, although for those that are feeling the squeeze from a mortgage repayment side of things, I wouldn't necessarily expect that to be happening anytime soon. And so I do think that you really need to address that problem personally rather than waiting for the RBA to address that problem. And then even beyond there, I mean, what do you see happen with the banks? Whenever there's a rate rise, they're the next day to increase the full amount. And then whenever there's a rate cut of 25 basis points, maybe they'll give you 15 basis points or 10.
Or they drag their feet and make it a lot longer before it comes into effect. But that's a really good segue into what's happening in the property market. And we might even talk about our experience with our clients in terms of what we're seeing as well too. But from a property perspective, and this comes from Domain, that we're seeing that most of the major property markets in Australia, Sydney, Brisbane, Adelaide, Perth, are reaching new house peaks, which is returning us to the pandemic boom types of highs. So from a property price perspective, we are seeing some resilience. In terms of our own personal experience, what we're seeing with our clients is that when interest rates were moving, there was uncertainty. Yeah. So yes, there was the cash flow implications of your mortgage getting more expensive because the interest rate had increased. But from the confidence level of consumers during that point in time, people didn't want to transact on properties. Now, even though it's at a higher rate, it's stabilized. Yeah. People know what the landscape looks like, and at least they can make these decisions with confidence. So what we are finding is that demand has returned. And it's not that people are not transacting and purchasing properties because interest rates are higher. It's that they're doing that now because they've got a greater sense of certainty and confidence around the economic landscape. And Andrew, over to you. Do you want us to round us out in terms of what we're seeing still with the rental market as well too? Because that's probably the other side of the coin that that we need to talk about with property.
Yeah, the rental market is still going absolutely bananas. I mean, the rental market, you're seeing people, and we're experiencing this not only with clients, we're experiencing this with our clients that are either looking to rent a property or are looking to lease out a property, in that there are multiple applications happening after one or two opens. And I mean, there was a property that was up for rent in my street, I think it was last week or the week before, and it was like there was a fate. I mean, no joke, there were people that were just walking through in droves, and it's absolutely crazy to see the prices that the renters are also being forced to pay. So when you consider that from a inflation perspective, people's budgets have been squeezed, from a property purchase perspective, people's budgets are being squeezed, from a rental perspective, people's budgets have been squeezed. Cash flow is absolutely king in this period of time, and unfortunately we're not seeing too much relief on the horizon for renters. It doesn't look like there's going to be a slowdown in immigration, or it doesn't look like there's going to be a massive increase in the supply of properties, and so very likely, we're probably likely to see that either stabilise at where it is or even continue further higher for rental prices as well.
Yeah, and I guess that gets even worse when you've got an incompetent and a prime minister and a leader of the country that lies to you. But we might just leave that final
leave it on that
final jab with that. But Andrew, thank you for today's episode. It was great. To our listeners and our viewers, thank you. I hope you got a bit of entertainment out of that as well too. And Anthony Albanese, if you are listening, please pay attention.
Thank you very much to all our listeners. Bills, thank you. And look forward to catching you on the next one. Like, subscribe, and we'll see you again another week.
Cheers.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.